Assalamualaikum warahmatullahi wabarakatuh. Today I will be presenting our group assignment MKW 3003 that is about stock prices portfolio. This assignment consists of two tasks. For task 1, we were asked to choose only one from four companies that we have selected and perform a few calculations. Meanwhile, for task 2, we were needed to build two portfolios containing two stock companies in each of it. So there are a few of agendas in our group assignment. Firstly, we have made our team task 1 about our company, formula list, data overview, and about task 2 is about companies also, and their portfolio, discussion of the portfolio, and conclusion for all of the portfolio. Introducing our team for our assignment. Firstly, we have Muhammad Ikmal bin Muhammad Rizwan. We have Christina Wafia and Nur Wahida Aini. There are also in our team Chia Tian Ai and Madunisa. So, for our group assignment for MKW 3003, there are few objectives. First, the objectives of the assignment is to plot the probability and cumulative distributions of stock returns. Second, to construct two portfolios and to compute their expected returns, variance, and covariance, also their correlations. Finally, to make decision in which portfolio the investor prefer to invest. There are a few methods that we choose to do our assignment. For task 1, we have chosen 5 types of method. Firstly, the return for the investment. Next, the probability of our investment so we know which company is higher risk or lower risk on investing. Finally, the average and the variance, also the standard deviation, so we could make our correlation to know what is the higher risk or lower risk company to invest. There are few methods that we choose to do our assignment for task 2. We also have chosen 5 types of method. Firstly, the covariance, the correlation of coefficient, expected returns, variance, and also standard deviations. These are all the formulas that we have chosen to make it happen. We proceed to our task 1. For task 1, we have chosen a company we call Tesla. Tesla is the top-selling electric cars in the world, which is led by Elon Musk, a billionaire which owns PayPal, Tesla, and also SpaceX. Tesla also maintains energy system and sells solar electricity and offers end-to-end clean energy products. Do you know Tesla has also opened their company in Malaysia, which makes in the future there will be a lot of electric cars in Malaysia. Here is shown the summary of returns for 1 year. The chart above shows the distribution returns of Tesla Incorporated, which are the daily data shown in Appendix 7. In Figure 17, the rate of returns is differencing every day. The highest value of return is 0.1100 at day 167, which is 27 January 2023. The lowest value of return is negative 0.1224 at day 150, which is 3rd January 2023. Firstly, to get the data, we need to open Google, search for Yahoo Finance. Then, click on the first link shown. On the search tab in Yahoo Finance, all you got to do is search for the company that we wanted to get the data from. As for my team, we are looking for the data of Tesla Incorporated. Then you scroll down a bit, click the historical data, set the date we want to choose for. As for my team, we set the data from 28th May and a years onward. Then click apply. Once the data is set, you can download the data. It will be downloaded in second in a Microsoft Excel format. To calculate the returns by using Microsoft Excel, all we need is the only data of the adjusted close, given the formula is current price minus previous price, divided by the previous price. The first day on the selected data is 31 May 2022. We set the return as 0 because there is no point shown on the previous day. Then for the data Then for the data, on the 1st June, we calculate the returns by inserting the formula. We start inserting the equal symbol followed by an open bracket. Click on the data 1st June minus the data of 31 May and then close the bracket. Divided it by the data of 31 May. Then click enter. Move the cursor to the small plus symbol, drag down until the last given data to calculate the rest of the returns. There you go. There it is, the returns of the data that we needed. To calculate the returns by using Microsoft Excel, all we need is the only data of the adjusted close, given the formula is current price minus previous price, divided by the previous price. The bracket, then insert all of the returns data, close the bracket, and click enter. To calculate the variance of the data, we use equal var.p. Open the bracket, then insert all of the returns data, close the bracket, and click enter. Same goes with the standard deviation. Use the formula equal stdev dot p and we will get the value of the standard deviation. Same goes with the standard deviation. Use the formula equal stdev dot p and we will get the value of the standard deviation. Same goes with. So we proceed to task 2. For task 2, we have chosen 4 companies. Firstly, we choose Tesla. Tesla Incorporated is an American multinational automotive and clean energy company. Tesla is also the biggest seller of plug-in electric vehicles. The base country of Tesla Incorporated is in Austin, Texas. The company engaged in the develops, designs, manufactures, sells, and leases of electric vehicles and energy regeneration and storage system. It is also install and maintain energy system and sells solar electricity and offer end-to-end clean energy products, including generation, storage, and consumption. By a network of company-owned stores and galleries, it markets and sells vehicles to consumers. For the picture, we have summary of return for 5 years data. The second company that we choose is Meta. Meta Platform Incorporated is coming from Facebook Incorporated as a social technology company. Meta is also the world's largest online social network, around 3.8 billion family of apps monthly active users. The company builds applications and technologies that help people connect, find communities, and grow businesses. Through its major product, Facebook, Instagram, Messenger, and others, the company can connect with people with their friends, family, and others across the world. It enables people to exchange messages and sharing new events, photos, and video. The base country of this company is in Menlo Park, California, United States. For the picture, we have summary of their returns for 5 years. For the third company that we choose, Netflix Incorporated is a global streaming entertainment company that was founded in 1997. Base country is in Los Gatos, California. Netflix started as a DVD by mail rental service and later transformed into a digital streaming platform. The company offers a vast library of movies, TV shows, and original content that subscribers can access and watch online. Netflix has disrupted traditional media consumption and remains a dominant player in the streaming industry. The company continues to invest in producing original content and expanding its international presence, solidifying its position as a leading provider on off-demand entertainment. Summary of the return for 5 years is shown in the picture. Amazon.com, commonly known as Amazon, is a multinational technology company founded by Jeff Bezos in July 1994. It is based on Seattle, Washington, United States. It is also one of the world's largest online retailers, offering a wide range of products and services. Amazon operates as an e-commerce platform, facilitating the buying and selling of goods through its online marketplace. The company has expanded into various sectors including cloud computing with Amazon Web Service (AWS), entertainment with Prime Video, and consumer electronics with devices like Kindle and Echo. Amazon's customer-centric approach, extensive product selection, and efficient delivery services have established it as a dominant player in the global market. So, we have also the summary of returns for 5 years. Moving on, we have set a portfolio. So, we are going to discuss about portfolio A. We have set two portfolio. For portfolio A, we decided to put Meta and Amazon. By using the same method as shown in the task 1, we calculated the expected return, the variance, and also the standard deviation. The expected return for Meta Platform Incorporated is 0.00186, while for Amazon.com, the expected return is 0.00037. The standard deviation of Meta Platform Incorporated is 0.03657. Meanwhile, Amazon.com Incorporated has 0.02741. Table shows the expected return average between the Meta Platform Incorporated and Amazon.com Incorporated is 0.001431. On the same time, the variance is 0.000977 and the standard deviation is 0.031264 in portfolio A. This chart shows the comparison of expected returns for portfolio A between the Meta company and the Amazon company. So, moving on to the correlation and covariance for portfolio A. In portfolio A, they are shown the covariance and correlation of Meta Platform Incorporated and Amazon Incorporated. The covariance in this table shows the result is 0.000606, while the correlation is 0.604226. Therefore, the relationship between Meta Platform Incorporated and Amazon.com Incorporated near to strong correlation coefficient. The video shown is the method on how to calculate the covariance and the correlation step by step. So, moving on to the correlation and covariance for portfolio A. In portfolio A, they are shown the covariance and correlation of Meta Platform Incorporated and Amazon Incorporated. The covariance in this table shows the result is 0.000606. For portfolio B, we have chosen a two company called Tesla and Netflix. In the table, we have shown which expected returns for Netflix is positive, which is 0.003109. Meanwhile, for Tesla Incorporated shows a negative expected returns, which is negative 0.00307. Meanwhile, for variance, Netflix Incorporated is 0.001013 and their standard deviation is 0.031823. The variance for Tesla Incorporated is 0.00015281. Meanwhile, the standard deviation is 0.0390909. For these two portfolio, they had same weight 1 and 2, which is 0.7 and 0.3. If we take the difference weight 1 and weight 2, the expected return, variance, and standard deviation of portfolio will be also different. According to the tables, we can say the expected return in portfolio B is higher than portfolio A. Compared to these two tables, we know the variance of portfolio B is lower than portfolio A. This shows a proof which is this chart shows the comparison of expected returns for portfolio B between the Netflix company and the Tesla company. In portfolio B, they are shown the covariance and correlation of Netflix Incorporated and Tesla Incorporated. Firstly, it is 0.00594. Meanwhile, the correlation for second one is 0.580937. Thus, it means that the relationship between these companies is weak correlation coefficient. Therefore, we can say the portfolio A had higher correlation than portfolio B, which is 0.640226 compared to 0.47765. For the covariance also, portfolio A is higher than portfolio B, which is 0.000606 compared to 0.000594. In portfolio B, they are shown the covariance and correlation of Netflix Incorporated and lastly, we have reached our discussion. According to task 1, the data shown a year ahead gives out a negative values of expected return, which is negative 0.000307. It also means that the initial investment cost is much higher than the profit gain in the end. Instead, free cash flow can be used to better comprehend the company's financial position. The variance calculated is 0.001528, which is low risk. Cautious investors typically do well with low variance stock market. Variance is a way to measure how risky an investment could get. Lastly, the standard deviation for the data is 0.0390909. The lower the standard deviation, the lower the risk associated with the investment made. Low standard deviation indicates the stable price for the stocks. Meanwhile, for the task 2, our group has finalized the decision to throw our investment in portfolio B. As you all know, when the calculated standard deviation is larger, the variability is much greater and hence the riskiness of the set of values. Since the standard deviation for portfolio B is smaller than portfolio A, which is 0.0299721, is more or less than 0.031264, it shows how less risky it is us to invest for the companies in portfolio B. The expected return for portfolio B shows a higher value compared to portfolio A, which is 0.002085 is way greater than 0.001431, which means they are quite low risk for us investors. For the data, the portfolio B is more suitable for investment because it offers a high expected return, low variance, and also standard deviation and correlation. So we have reached the end of our assignment video. Thank you for watching.